Hi everyone, my name is Victor Lai with BCM and welcome to part 3 of Investing 101. I hope that you found the first and second parts of this series to be helpful. In this third and final part, we're going to take a look at or finish talking about what we can do as long-term investors to grow our money. But before we do that, let's start with a quick review of what we talked about in part 2. In part 2, we saw that stocks have historically produced the highest returns relative to other asset classes like bonds, gold, real estate, and cash. However, even though the stock market has done well, on average, individuals have not. And based on historical observations, that difference is most likely due to bad timing. Investors tend to buy and sell at the wrong times. And regardless of why it happens, the lesson to learn is that it is practically impossible to correctly and consistently time short-term market movements. And the truth is, the more we do it, the more chances we have to lose money. On the other hand, one of the most reliable ways to increase the chances of earning a positive return is to extend holding period. Many investors rely on that principle by using a simple buy and hold strategy. For example, just buy a stock index and hold it until it makes money. Which brings us to this question. Is that all we have to do? Is that enough? Is that the best we can do? And to answer that question, we need to look at something other than just returns. We need to consider another factor. That factor is called risk. People often think of risk as losing money, but losing money is not the same thing as risk. Losing money is a consequence of risk, and so is making money. In finance, risk is defined as volatility. Something that is volatile is risky because its outcome is uncertain. For example, the stock market is volatile, and so it's risky. Everyone knows that risk and return go hand in hand. No pain, no gain. No risk, no reward. The table on the upper left of this page shows us that relationship in practice. It shows the returns for two portfolios over 2 years. The red portfolio is very volatile. We can think of it as an aggressive and risky investment. The blue portfolio is less volatile. We can think of it as a conservative, or at least more conservative, and less risky portfolio. In year 1, the red portfolio earns 30%. In year 2, it loses 20%. The average return over the 2 years is then 5% per year. Meanwhile, the blue portfolio earns 6% in year 1 and 2% in year 2. Its average return is 4% per year. Now, just looking at the bottom line, there really isn't much difference between the two. I mean, 4% basically looks the same as 5%. However, the outcome is actually very different. If we started with $1 million in each portfolio, after 2 years, the riskier red portfolio would have produced $40,000 in gains. Meanwhile, the less risky blue portfolio would have produced over $81,000 in gains. The difference is shown by the graph on the upper right. And it's a really big difference. The less risky portfolio earned over twice as much as the riskier portfolio, and it did it with a lower average return. That's not what we would expect here. And there's no trick. The reason is that gains and losses have an asymmetric relationship. In other words, it requires disproportionately larger gains to make up for any losses. This is shown by the graph on the bottom of the page. If we lose 10%, we need 11% to get back to even. If we lose 80%, we need 400% to get back. So as far as growing money is concerned, the reality is that over time, avoiding big losses is far more important than capturing big gains. Too much volatility is bad because it creates the potential for large losses, and over time those losses can really hurt. The difference that you see on this page, this happened just after 2 years of volatility. Imagine the impact that 10, 20, or 30 years could have. So now that we understand why risk matters, let's take a look at how to properly evaluate investment performance. Let's say that my portfolio earned 20% last year. And let's say at the same time the market did 18%. This is shown on the chart on the left here. At face value, it looks like I outperformed. However, as we just saw, returns are only half the story. To figure out whether or not I really outperformed, I have to evaluate this on a risk-adjusted basis, which means I need to look at how much return I earned relative to how much risk I took on. To visualize this, we can look at this, or these two portfolios, on 2 dimensions. That's shown on the right. In addition to showing return on the vertical axis, we are also going to show risk on the horizontal axis. So going up on this chart means higher returns, and going to the right means higher risk. Now let's go ahead and plot our two portfolios. Let's say that in order to earn that extra 2% in return, I had to take on a lot of extra risk. Now, on a risk-adjusted basis, my performance doesn't look so good anymore. Remember that volatility cuts both ways. And with this much volatility, I risk swinging the other way deep into negative territory. So, I mean, even if I earned twice as much as the market, if I did it by taking on twice as much risk, then there really wasn't any outperformance. On the other hand, if I earn the same return as the market, but I do it with less risk, then I've actually outperformed on a risk-adjusted basis. This is all a long-winded way of saying that what we want is the highest level of return for any given level of risk. This concept is known as portfolio efficiency. And the question is, how do we do it? Well, there's actually an entire field of academic study dedicated to this. It's called Modern Portfolio Theory, or MPT. The details of MPT are not important for us right now, but in case anyone is interested, I will post a separate presentation on it later. But as for now, all we need to do is understand one takeaway from MPT. It's called correlation. Correlation is a statistical concept that measures how two things move relative to one another, shown by the arrows you see on the left. For example, stocks like Microsoft and Oracle are very likely to move up and down at the same times. I mean, unless there's something specific happening to only one of the companies. In other words, the two stocks generally are positively correlated. In contrast, two things that move in opposite directions would be negatively correlated. A good example of negatively correlated investments is stocks and bonds. The table on the right shows the various bear markets that U.S. stocks have experienced since 1968. Every time stocks have tanked, the bond market has typically done well. Now, there's lots of reasons for this, but basically what's going on is when investors sell stocks, they're typically buying bonds and vice versa. And the outcome is that when one goes up, the other goes down. In other words, the two are negatively correlated. Now, the reason that correlation matters is that it can affect risk. One of the core findings of MPT is the following. The total risk of A and B does not equal the risk of A plus the risk of B. It equals the risk of A plus the risk of B plus the correlation between A and B. And since correlation can be positive or negative, that means correlation can increase or decrease a portfolio's total risk. This is one of those rare occasions when 1 plus 1 does not equal 2. And the lesson is that by combining low or negatively correlated assets, we can actually manipulate portfolio risk and tilt the risk-return relationship in our favor. This next slide shows how this would have played out in the real world. The table that we see on the left shows the annual returns for two portfolios. The red portfolio that reads 100% stocks is based on the actual historical annual returns of the U.S. stock market from 1990 to 2010. The blue portfolio that says 50-50 is based on a hypothetical portfolio that was invested half into the U.S. stock market and half into the U.S. bond market over the same period. The chart that we see on the upper right shows how $1,000 invested in each portfolio would have grown over this time period. And we can see that both portfolios basically ended up at the same place. They essentially made the same amount of money. We can also see this on the chart on the bottom right, which shows us return over risk. Looking at the vertical axis, we can see that both portfolios earned about 8%, more or less. However, the 100% stock portfolio did it with twice as much risk, which we can see on the horizontal axis. Even though the blue 50-50 portfolio never had a huge 30% up year like the stock market did, it also never had a nasty 30% down year. And that made all the difference. The less risky portfolio didn't need to hit any home runs in order to outperform. So to answer our question, we're just going to say no. Simply buying and holding a stock index is not the best thing we can do. And that's because stocks are very volatile. Even if we're holding a broad stock market index, at the end of the day, we're still only holding stocks. And the fact that they're all correlated means that our volatility could even go higher. What we want to do is to allocate a portfolio across different types of assets based on correlations. The goal is to combine the right asset classes in the right proportions. This is commonly known as asset allocation. The proper way to construct an asset allocation is based on MPT, and it's beyond the scope of this presentation, but the point is that done correctly, we can actually tilt risk and return in our favor. In other words, we can increase portfolio efficiency and improve risk-adjusted performance. Okay, so we've come to the end of the presentation, and since we've covered a lot in the series, I'm going to wrap up with a quick summary, and I'm going to start from the very beginning. We know that inflation is a big problem for long-term investors, and historically stocks have been the best way to outpace inflation. However, investors on average have not kept up with the stock market, and that's most likely due to bad timing decisions. And the way around that is to simply extend holding period, because that is one of the most reliable ways to increase the chances of positive return. Returns, however, are only half the story. As we saw, risk or volatility is just as important as returns because it can really hurt performance over time. This is due to the asymmetry of losses, and ultimately high levels of volatility create the potential for large losses, and as we saw, avoiding large losses can actually be more important than capturing large gains. So that's why a simple buy and hold approach is not the best thing to do. Simply buying and holding a stock market index, regardless of how broad it is, results in high levels of volatility. What we want ultimately is to manipulate risk and return so that it works in our favor, or in other words, we want to increase portfolio efficiency. The way we do that is by combining the right combination of non-correlated asset classes, and when we do it correctly, we can actually lower overall portfolio risk without necessarily sacrificing return. In other words, it can produce real outperformance on a risk-adjusted basis. Alright, so thank you all for watching Investing 101. If you enjoyed this presentation, then please visit BCM's website at bellwethercm.com. Click on the contact page and check out the social media links. Please subscribe, follow, like, and share the content. And if you or anyone you know has questions or needs help with investing, please feel free to contact me. Otherwise, thanks again for watching, and please stay tuned for some important disclosures.